want to get started with our second panel of the day, who will explore innovation in competitive markets. We've asked Bill Zuretti, EPSA's Director of Regulatory Affairs and Counsel, and this great panel to discuss the following questions. How have markets been instrumental to new technology on the grid? How do new and innovative technologies get deployed? What are some of the barriers to getting that new technology on the grid? And other questions. So we know that we have folks that can answer all of those questions and hopefully give you a little perspective from the development and innovation seat. So with that, Bill, I'm going to turn it over to you and the panel.
Excellent. Thank you, Todd. This is a tough act to follow with Nancy. She opted for sort of the fireside chat approach. We're going to go a little bit more with sort of the Phil Donahue end of show, sort of just lob questions out there. I'm not going to be running with the mic back and forth to each of you, but it'll be a little more open scrum. Though, Sherman, you have drawn the short straw in the leadoff spot for the first question. Todd covered a lot of what I wanted to talk about in my introduction, but each of these companies up here have developed a number of innovative products. Next generation resources, everything from renewables to state-of-the-art gas plants to some of the largest battery storage projects in the world. And these investments were all based on market signals with no risk to captive ratepayers. As you can tell, we have an esteemed panel of guests here. Their reputations precede them. I won't go too much into their backgrounds, so that information is available on our website if you want to dig deeper into it. I'll just start left to right here. To my left, you have Sherman Knight. Sherman's president and CCO of Competitive Power Ventures. Next, we have Curt Morgan. Curt is the CEO of Vistra Corp. Then Nathan Hanson. Nate is president of LS Power Generation. And finally, Kevin Smith, president of Tenaska Power Services Company. So I'll start with sort of a good, an open-ended question here. And again, Sherman, you drew the short straw. Your companies vary in size and structure, but all have been innovators. Can you speak to what you're hearing and seeing from your investors in terms of their preferences for new and innovative products? And how do you expect those preferences to evolve in the next 5 to 10 years as technology continues to change?
Well, first, thank you to EPSA for putting this on, fellow panelists. I'm honored to be on this panel. I think what we are seeing from investors is a strong amount of capital that wants to invest in ESG investments. That's been clear. I think what's not so clear is exactly what an ESG investment is. And I think it's something that we spend a lot of time kind of like probing around. For example, if you add a renewable project in a highly penetrated market that is displacing other renewable projects, is that an ESG investment, where a natural gas project displacing coal is not? And I think as we see things going forward, I think there will be more of a standard, clear definition around what ESG really stands for, or at least maybe I'm an optimist and I'm just hoping that will be the case. But there definitely is a clear push for that sustainability goals to occur.
Great. Curt, we'll just go down the line here. You're the publicly traded company on the panel. Do you have a sort of similar view, or how are things different for you all?
Well, there's no doubt that ESG investing, just the amount of money that's gone into ESG investing. I agree with Sherman, though, it's complicated. I think, though, you still, in my opinion, you have to find good economic investments. You can't follow the trend. I mean, I don't know how it happened, but in 2021 it was growth, and then it seemed like, after New Year's, it went to value trading. And many of the stocks that were trading at multiples of revenues are now, their stock prices dropped dramatically, and those are some of the biggest ESG, companies, growth companies. So I think it's still, we as stewards of capital still have to find the right investments. And I also think that investors, they're focused on ESG, but make no mistake, ultimately they're going to look for returns. And I think you've seen a little bit of a pivot here recently with Larry Fink's recent letter, opening a door that for shades of brown, shades of green, and a recognition that this great that the last panel just talked about, but this transition is going to take some time, and it's going to require some level of fossil fuels, and I think that's been admitted. There's a letter you should read too State Street Bank CEO put out, which is very similar to that. And I think what the investors are beginning to think about is, you know, what does this transition really look like? And they're also thinking about returns. And I think that's one of the things that we have to take into account. Now, there's no doubt that, you know, we've made investments in you know, ESG type projects. Sure. But they were driven by economics ultimately. And we're retiring a significant amount of coal, which has been driven by economics. And that will always be what drives us at the end of the day. But you can't help but look at the capital markets, though, and be concerned about, you know, how they're going to allocate capital. And so each of us needs to make, you know, the right decisions for our companies. But we're going to be driven more by economics than we are by the flavor of the day that will come and go.
Yeah, look, very similar for us. Our investors are very focused on the energy transition. We've actually created an energy transition platform with demand-side management companies, electric vehicle charging companies, renewable development company. We started developing batteries back in 2015. So at the end of the day, what we see is capital will go to that space. They're very interested in it. But one thing that our investors are making sure that their understanding is, what are the return on these investments? So very similar to what Curt said. And so I think, you know, one of the things that we decided to do is, as part of this energy transition, to let them participate in it a little bit further, is we created an energy transition company called Rev Renewables, which consists of about 2,000 megawatts of pump storage, about 900 megawatts of battery storage in operation and development, 500 megawatt solar portfolio, and a wind farm, along with a large development pipeline. That's very interesting, and maybe I think this area is changing so rapidly. We have a development business on one portion of our business where we develop generation resources, transmission. The other side of the business, we also have raised private equity funds to invest in the energy space in various areas. We raised our fourth fund. We traditionally only purchased power plants, historically, for the most part. And our first investment in Fund 4 was the company called EVgo, which is now a public company. And our investors at that point were questioning, so what's the opportunity here? And they've since now seen the light of at least what we were trying to do. But we're still at the very beginning of this whole process. There is a long way to go in transitioning the energy space to be able to implement low carbon resources, both in the wholesale supply sector, but also on the residential, commercial, and industrial sector. That's a large part that really we haven't talked much about here today, but I think it will be integral down the road in terms of being able to meet the climate objectives everybody wants to meet. So, makes sense. I'll leave it at that.
Okay. Well, our investors right now are still focused on solar and energy storage, despite the current headwinds and challenges. I think as we look to the next 5 to 10 years, those preferences will clearly evolve. But I think they will evolve within the ESG space. I think we'll also see those preferences driven by technology changes. But we could also see preferences be dictated by regulatory mandates or incentives. I think we've had the luxury of a abundant capital market where there's been a willingness to invest in every technology type. And yeah, as Curt said, people are going to be more focused on the returns. And so I think that the focus will gravitate more towards those technologies which will yield near-term cash flows.
Great. I think that's a pretty wide gamut that we heard there. You know, and to tie it into sort of a follow-up there, you know, are the markets sending the right signals, the competitive markets where you rely on those revenues to incent those types of investments? You know, again, that's you know, obviously different companies, different structures, different investors, but again, I think, you know, are the markets right now equipped and sending the signals that you need to meet those demands? And that's open-ended.
Sure, I'll start. One of the things is when you raise capital, you have to explain how the markets work, and I always find it amusing as you try and get into, especially in the renewable space, like, oh yes, if you put a wind plant in Pennsylvania, you'll get, you know, a kicker to the energy market about $20. But if it's solar, it's actually, you know, 35. But if you move it to Maryland, it's 25. But then it comes down to 20 because the ACP comes down. And in West Virginia, you know, you're not. And if you're in Texas, it's only 5. But if you're offsetting carbon, you know, at a power plant, you know, in, you know, Maryland, it's 7. But Virginia, it's 0. You know, like. And people just kind of like, they look at you like, what are you talking about? So when we talk about competitive markets, like, you know, the traditional space of electricity and capacity are pretty straightforward, and I think they're functioning, you know, at a large degree. And obviously, you know, there's a lot of tinkers there that could be improved, but for the most part, they're functioning very well. I think when we get into the renewable and, you know, especially along the carbon space, it is a vast array of small state policies, and I think that, you know, those they do incentivize, you know, private capital. It's just from a, you know, personal perspective, it's like with the lack of federal leadership in creating a national type carbon policy, we feel like we're, you know, chasing state mandates as opposed to focusing on reliability and reducing carbon in the industry. And that gets a little bit frustrating. It works, you know, we can do it, you know, but certainly, you know, is less effective than if there was a, you know, whether it's federal or even just a regional, you know, within an RTO consistent, you know, policy.
Sure.
I think one of the signals we're seeing, which isn't positive, is that the tenor for certainty and stability is becoming shorter and shorter. And that's not a signal most investors want to see. Now, on the positive side, we are seeing customers continue to pursue their ESG goals, and so that's continuing to drive competition in the renewable sector.
Yeah, look, I think we're at a crossroads in markets. I don't think that they are supportive of new investment. I think I've said this many times, we've got a broken development model where anybody can throw something together, get paid a development fee, and flip it to somebody and not have to own it. And that has a lot of things that get built that end up, heck, I've made a career out of buying other people's stuff, you know, after, you know, went in and out of bankruptcy 3 times. And we're going to see that, I think, in the renewable side as well. But, you know, this does, you know, dovetail a little bit off of the reliability discussion, but the reality is that the way that we've done this in the past isn't going to work in the future. And, you know, there's a huge dislike for capacity markets, but we have to have something. Thad said this, I agree with him. We kind of moved away from some of these things because the new FERC administration that came in didn't like MOPR, so we threw it out the door, but we didn't have anything behind it. And so, you know, we've seen nothing but capacity prices go down. Energy prices are being under attack because of zero marginal cost or negative marginal cost resources, and we don't have anything to come in behind it. And look, I may be the boy that cried wolf, but that's okay. I'm telling you, though, that there is a big disconnect coming in places like PJM, in places like ISO New England, if we don't do something about this. You know, we've got to make sure and I think, Manu, you said this, we've got to have an analysis done that figures out the marginal resource that is necessary under the most extreme circumstance with the intermittent resources out that will ensure reliability. And the ISOs have to be the ones to step up to do this because they're the objective person. If we come to the table, what do people say? Oh, they're those greedy generators. You know, they're just talking their book again. And I'm concerned that we're not in that position to do that. We've got reserve margins going down, intermittent resources going up, and it actually should be going the other way. in terms of reserve margins. That 30% reserve margin that you have, you would want to keep that with the kind of, and I know you know this, with the penetration of intermittent resources. So I don't think markets there's too many hands in it. You know, the states and do not like capacity markets. They've had a huge seat at the table, and I don't think it's going to be helpful to stimulate new investment with the way things are going today.
Yeah, just to add on maybe a little bit there, I mean, the development cycle on renewables has been for developers to get a site, develop it, either flip it to somebody, or get a PPA, which, you know, could be 10 to 15 years with a huge tail on the back end, but there's like zero cash flow coming out of this thing for 15 years, and who knows if the facility will be operating at the end of the day. So that is a broken system. That doesn't work. That leads to, you know, overbuild situations and not enough capital in the system to support continued operation of these types of facilities. And to repower them effectively, except in a lot of, you know, small subset of instances, is really like building a new facility, because the turbine technology changes so quickly, or the panel technology changes. So I agree with that. I think the markets are not supporting the development of these types of assets, the renewable assets, except in certain state, you know, run REC programs, which, you know, if you look back, a lot of these were put in over the last 5 to 10 years. They've done what they were supposed to do. They're developing assets within their state, but they're all based on these targets that have expanding, you know, attributes growing over time, and we've been effectively woefully short on meeting those development targets to be able to meet those targets when you look out 5 years. And so even those programs are not providing enough incentive to accelerate the growth, and permitting and siting these assets are getting harder and harder. The easy ones are already done. Now you got to go to the next hardest one to permit, and it's only going to get worse. So, you know, I agree with Sherman that, you know, a uniform type of platform, whether it be a carbon price, or if you're going to pay for environmental attributes, you should pay for them and let the market decide how to most efficiently develop those. Right now, we have a patchwork system that really isn't supporting the true investment of what these facilities cost to build. So,
you know, I don't know how you build a gas plant today in a competitive market with not knowing how long it's going to be around. I mean, the EPA administrator is attacking coal in a very significant way with some recent moves that they've made. So coal is going to be gone. And I heard Gina McCarthy say that we're now going to pivot over to gas. But I don't know how you can go out in these markets today and invest in a natural gas plant. And you've seen what Illinois did, right? They're going to sunset their gas plants. You know, and then I look at it and say, what are going to be the reliability resources that are out there? When you've got coal that's under attack and going to be pushed out, no doubt about it, and with a target going to natural gas next, it's hard for me to look at that and say that markets are supportive of new investment. I don't see it. And, you know, somebody may do it, and, you know, good for them if they make a development fee. I wouldn't want to be the equity in it, but again, I may buy it after a couple, 3 times in bankruptcy. But, you know, look, seriously though, I mean, I don't know how you look at these markets and say they're conducive to investment. The reason we've done it, we had a legislation in Illinois that pays over 50% of the revenue stream that needs to be paid, and in California the same thing. The investments in Texas are largely to support our retail business, and they have economics to them. But the markets are not really conducive to investment, and there's a lot of turmoil going on out there with not knowing how long that investment will be there. You know, what is the tail?
Yeah, and I think it was Devin that said we have an education problem, and and Jim talked about energy versus capacity. And I think part of that education challenge is helping people understand that a megawatt of intermittent resources is not equivalent to a megawatt of dispatchable generation. It's not equivalent from a capacity perspective. It's not equivalent from an energy perspective. The renewable assets don't have the same reliability and resiliency attributes that a dispatchable unit has. And the market isn't currently sending signals that value those attributes. And so therefore you have baseload dispatchable resources retiring at a rate that's not being kept up with on the renewable side. And part of that, it's different signals.
But Kevin, would you agree that we have to apply that, not just to renewables, but we have to apply that to the attributes of fossil fuels as well? Thad, you said this. If it's, if it takes you 24 hours to start up, that's not that useful with a grid with intermittent resources.
Absolutely.
So, combined cycle plants that have much more flexibility ought to have a higher effectiveness rating than, a steamer, gas steamer that takes 24 hours to start up.
And a quick
or
start
a coal
aeroderivative.
But if we don't come to the table and have that kind of discussion, then the states are we're going to turn them off, right? Because they're going to say all they care about is trying to stop renewables. That's not what we're about. And at EPSA, that's not what we're about. We support renewables. We understand and believe in climate change, but we want a element of fairness and get paid for the attributes that we bring to the table. And I think the attributes of many of the dispatchable resources are going to actually go up, and the value is going to go up. But it's how do you allocate those funds that today are being paid out in capacity? What the states don't like is just throwing it out in blanket form. But if we can actually show the attributes, and Manu, you can talk about that this is the type of resource I have to have in order to do my number one job, which is reliability. Now we have a seat at the table and we can have a discussion about something. But we can't just come in always pushing our own deal. We have to admit that some of our dispatchable resources are less effective than others.
Yeah, I think that's exactly right. I think performance should be, uniform across the board. If you're going to provide a reliability type of product, what does that mean? I think we started with these markets where everything was homogeneous. Everything could turn on when you wanted it to turn on. They all came out of utility-based systems, so they were kind of over-engineered. Over time, that's transitioned a little bit, and now with intermittency involved with the markets, it's even going to get worse. But, we try to step change this stuff, and I think, we're talking about ELCC mechanisms across, various RTOs that should take all those types of attributes into account, but what we need to define and have the RTOs define for us is what are the attributes that they need and when do they need them? Is it in 5 years from now? Is it in 10 years based on, their projections? And then try to design a market that can, pay for those attributes, and then investment will come and meet the needs of the RTO. And it's going to be different by RTO. You have different supply resources, you have different kind of bandwidth, you have different transmission arrangements. So the definition of what those reliability attributes are going to differ by pool, but looking out a little bit further, trying to define them now to try to create a structure that can move in that direction to provide that incentive, I think is what's necessary.
I think you're right. I just want to make sure because I hear what you're saying that price signals do not currently, support investment in new dispatchable generation in most of the country. I think that what we have to be careful about is saying competitive markets aren't incentivizing investment, and I think that is absolutely not true. I think what we're talking about here is tweaking the competitive markets, changing them, and maybe tweak is too light of a term, but changing them as the infrastructure transition occurs to hit those attributes so that it can unleash the power of private capital come in and make investments, or not have private companies preserve capital by retiring perfectly good assets that are needed for the transition.
Competitive markets definitely work.
Yes.
And the market has benefited from the capacity markets, but we've also had external forces injecting itself into competitive markets. And that's where the challenge comes up. And so we do need to keep the competitive markets, but we need to recognize the attributes that are going to be needed for reliability, resiliency, as we move to a low carbon, no carbon environment or grid. And we need to make sure that these competitive markets are recognizing them and compensating for them. But along those lines, you know, a national carbon price. So we're not just sitting here talking about only the reliability and resilient attributes, but a national carbon price that would level the playing field for all resources. And everybody should have the same standard, regardless of technology. No free rides, everybody held to the same standard. Let the market decide what's the best technology to meet the needs and the attributes that the market is desiring.
Yeah, so look, Sherman, I'm not saying anything about whether competitive markets do what we want them to do. The question was, are markets sending the right price signals? And I don't know how you can say that $50 a megawatt day or $2 or less a kW a month on a capacity clear supports new build of a gas plant. I don't see how that can be. So I'm just talking about the facts. You know, I'm not trying to say competitive markets are wrong. Look, competitive markets have brought better reliability, lower cost. You know, Thad had some good facts that he threw out. But the bottom line is competitive markets, and I'm a huge believer in that. But we got a lot of hands in these markets, and a lot of the forces are driving to drive lower and lower capacity clears. And I don't see how you can invest with the kind of clears that we're seeing. And I don't see that turn around anytime soon. So that's all I was saying. I'm not, my comments were not an indictment at all on competitive markets. I'm clearly supportive of competitive markets.
I guess building on some of that discussion, you know, we talked a little bit about a carbon price, and EPSA is strongly supportive of a carbon price. But maybe other than that, at the national level, are there any other sort of policy decisions that could be made that would be beneficial to incent innovation? For example, how do you see FERC Order 2222 playing out in competitive markets, and what are sort of the challenges and opportunities that might arise from its implementation? And you know, feel free to mention others that might be beneficial.
Maybe I'll start on that one since we're a big DR owner. So.
Sure.
Look, we think the policy, and you can even take it back to FERC Order 1000 with the competitive transmission stuff, the policy is the right move in the right direction. Where we stumble on these, you know, expanding those opportunities is really how do they get implemented? You get into the food fight at the various RTOs of, okay, what does this mean? How are we going to adjust our implementation? And we find that they become very stringent. In terms of what qualifies for competitive solicitation or what doesn't. And so while I think the FERC policies, and we're seeing that play out right now with FERC Order 2222 in the DR space in terms of various metering obligations and, you know, performance criteria. Look, I think a uniform, if these types of assets are going to qualify for providing either energy response or reliability services, they need to perform just like every other asset that provides those services with the same performance penalties. You know, we stick DR kind of on the back burner as a last resort type of use. They all bid in at very high energy prices. Hopefully they don't get dispatched. That's not going to last forever. These types of assets, especially the behind the meter assets, should be used, you know, more frequently to be able to balance the system. I think about it as, I guess I'm on the older side, but you know, when you had the old stereo, it had the fine tune, and you know, these types of assets can be used for that. And right now we don't. And so, but implementing these kind of policy changes, while I think they're great in terms of their intent, they seem to break down when we go to the implementation phase of the various RTOs. And that's been a struggle. We're still dealing with that on the DR space. We're still fighting about certain, what qualifies, what doesn't qualify under FERC Order 1000. I just think, at some point, we need to be able to work with FERC so that they can make sure that the policy is implemented in a manner in which they thought they were trying to accomplish. And that's a very arduous process in our system here, so.
Yeah, look, I agree with the comments you made about the one that really concerns me is there's a diverse set. When you look at distributed generation, there's a diverse set of ownership, and the idea that household solar panels are going to be equal to guys like you that own it, and there's not standards. The one thing about electricity in the years past is that you had major companies that owned it that were held to certain standards and performance standards. The further this thing gets away from that, it gets distributed, the harder it's going to be to pull all that together and make sure that those performance standards are met. And that leads me to believe that there's a lot of work to do in terms of the implementation of FERC 2222. And I don't see it really on the horizon here in the next couple of years. I think there's a lot more work yet to be done. Just national policy, I still think that something around carbon should happen. Whether it will happen, I don't know. I'd love to see something happen, regionally. We've talked to both PJM and ISO New England about it. I know Gordon, we talked about this yesterday. I'd love to see something happen in New England. I thought that was a set of, fairly homogeneous states that might do something like that. But unfortunately, I think that states like to invest their money directly, and they want to see things actually happen. The trouble with that is that is an uneven playing field, and as you guys know, it's like a balloon. You push in one side, it pops out the other. Illinois put the legislation in place, and what's going to happen is you're going to see coal plants in West Virginia or Pennsylvania or somewhere else just increase the amount of production, and who's going to get hurt? The natural gas plants in Illinois. So I understand the propensity to want to do things. Everybody wants to act and be the best at dealing with climate change, but if we don't do this in some coordinated way, it's not going to be effective. And people have done a bunch of modeling on this issue, and the most direct way, the most transparent way, with an even playing field, is a price on carbon, a direct price on carbon. You can increase it over time. You can put a border carbon adjustment on it so that it forces other countries to do that before they can get in, and you raise revenues that you can, if you want to, progressively dividend back to American people who cannot afford the cost. Because the secret that no one wants to admit, whether you're doing subsidies or what you're doing, is you are increasing the cost of electricity in this country enormously in order to make this change. We see it in California, where prices are 3 to 4 times higher than what they are in the state of Texas, and other markets. We see trends going up in the Northeast the same way. And this is one way to raise revenues against it and give people a direct view of what the cost is of carbon to the economy. And you can do it economy-wide too, because we're not going to get to 1.5 to 2 degrees Celsius if we do not also apply this across the economy. You can't just make the electric sector the only one that does this. The largest contributor now to greenhouse gas emissions is the transportation sector. And of course, we've got agriculture, building, and construction, all those things that still need it. Carbon price is the way to actually do that on an economy-wide basis.
I'll add to that, because I think it's worth saying one more time, national carbon price. It's such a no-brainer, especially, I think economy-wide, there can be a diverse set of views, but within the power sector that we're, all here for, it is straightforward, it is efficient, and it gets, it gets the job done. The energy transition is going to be expensive. I mean, it is going to be expensive. I 100% agree with that. And it's going to be far more expensive if we go around choosing pet projects here, here, and here, and here. And in that actually, I think I further agree. You choose those pet projects, it isn't necessarily guaranteed that you're going to get to the climate goals that we want to. National carbon price, it absolutely makes sense.
Well, I think we agree with that, but I guess to follow up, given the challenges around implementation of a national carbon price, is there a next best approach that might be adequate or workable? I know there's also some state approaches, and we've mentioned, I think, Reggie earlier, which has some challenges given where it is and the push-pull of some states within PJM now being in, some talking about getting out, and there's always sort of that tension there, so it creates some leakage issues. Like, is there anything else, if in the event, as we wait for a national carbon price, that might sort of fit the bill for the time being?
I'm not very good with politics, but I'd much rather see a strong backbone and see some leadership on a national carbon price. But yes, I mean, if, as Curt said, I mean, you can implement that on an RTO basis. That's better than not having anything, better than doing it state by state and trying to work with the rules so that there's not leakage between the RTOs. But that's it's kind of like, I don't know. Is it better to like cut half the cancer out of your body, or like do the whole thing?
Right,
I mean,
right,
like
yeah.
But
The whole thing, I think.
yeah.
Yeah, clean energy standard can be applied and get the same type of effects, but what was in the, if I think it was in the infra bill, that was not going to be helpful. But there are opportunities around a clean energy standard. I like the idea that you use the consumer to essentially push that through the daisy chain and get new renewables and batteries built. But I don't know why we continue, though, to have this debate about what's the most direct way, what's the most even playing field, what seems to be administratively easy to do. And for the life of me, and I've met with a lot of people on Capitol Hill, I think many of you guys probably have too, and I still can't quite get my head around why we can't get something like that, like a carbon price done. It's baffling, I think, to all of us. Hopefully, there is movement, though. I will say, I'm not as pessimistic as I was a year ago.
But Bill, to your question, look, these patchwork systems that we have now, or expansion of them, it's just less efficient. Which is, at the end of the day, it's more costly to consumers. And if we really want to do it the correct way, we are in agreement that a national carbon price, economy-wide, would be the best. That would drive change. It's like when you're raising your children, they have bad behavior. You address it. And if carbon is the bad behavior, then we should make it more expensive for people to use it. And that will change behavior most quickly and most efficiently.
And if it gets rid of the state-by-state initiatives, which creates that patchwork, it would address the leakage issue that you talked about. And for those of y'all that don't really understand that terminology of leakage, you have some states that participate in RGGI and a neighboring state may not. And so if you have an asset in a RGGI state, you're incurring carbon cost while the market price is being set by an asset in a neighboring state that's not subject to those same costs.
For sure, and I think we're coming up on the 5-minute mark here, so I'll sneak in a quick one on development for you here, Sherman. I know that, and I think, Curt, you're in a similar space. You're working on a few coal to solar projects right now that are pretty interesting, and there's obviously political support for renewables and transition policies. What are some of the challenges, and what are, in terms of implementation, and what more could be done to incent and spur policies of this or changes of this kind, sort of via the markets or otherwise?
I think one of the biggest issues that's going to come up, and it's going to become incredibly apparent, is the interconnection queue reform. And I know PJM's working. I know Manu, you're working hard on doing that. But we've set aggressive targets, whether it's state or not necessarily mandates, but federally, with regards to the Paris. And in order to hit those targets, you actually have to interconnect renewables into the grid. Right. and we just have a lack of ability to push through to do that. And whether that's more engineering resources to get studies done, and I'm not saying it's easy by any means, because we've gone from a handful of interconnection requests to thousands now, with much more distributed across the grid. But I think that's a bottleneck in the system right now. That's not totally apparent, at least that from where I sit, that is going to miss the state goals that they want to achieve. But I think that's a big bottleneck. There's a whole bunch of things that are obviously outside of our control, that are affecting the industry that I won't go into. But that's one that I think that we as an industry can kind of address and hit pretty head on, to find a more effective way of interconnecting in.
We definitely need to hit that head on, and we need the ISOs and the TOs to be innovative in coming up with solutions. The old way of doing things isn't working, and the costs are excessive. We talk about the cost of this energy transition. A huge amount of that cost is in the wires, and we're not going to be able to get the renewables built that people want if we don't address the interconnect queue, but then also the cost of fixing the system.
The other thing I'd say is that right now, and where we're building batteries in particular, but this can be true of other resources, we're using old operating protocols with the ISOs, which do not allow the full functionality of the resource. And in particular, batteries with their instantaneous start and flexibility in terms of operations. And we're trying to bring along ERCOT and California. California is ahead of most states just because they have so much more battery storage.
I think down the road, siting is getting harder and harder. We've seen that with all our infrastructure projects. And trying to, think through what are all the transmission upgrades that we're going to need? How far out? And does it, are we able to complete those with the amount of, regulation around trying to permit something these days will be a big roadblock and get harder and harder the further penetration we get with renewables. And so I think starting to think about that from a reliability perspective and thinking out 5 to 10 years is something that will need to be addressed, because we've seen that nobody can build a gas pipeline except in Texas anymore. So, how are we going to build all these transmission lines unless you're in the same corridor, which they won't all necessarily be.
You have to excuse my timing here. We actually do have time for more questions. I didn't mean to rush us to the end here. So I'll move into another one. As the nation continues to electrify, how are your companies preparing to meet that demand? And what role can markets play in meeting that demand or in spurring innovation and investment?
Yeah, that's a very interesting question. And I think, from where we stand, we do not typically take, our base when we look at investments, a strong view on electric growth through electrification. Having said that, we definitely run sensitivities and look at that, because I think that there's a real potential. And I think the way that we see that is we're when I started in the industry 20 years ago, you're arguing about, is it 1 or 2% growth? And now, you're arguing between, is it going to be flat growth or we're going to grow 40%? I mean, it's like that the range is so large depending upon what the electrification, speed of electrification will occur. And, in conjunction with that potential growth, with some of the price signals that we're talking about with dispatchable generation retiring, you see a lot of really, you run the market, consultant report, you hit F9 and it just like breaks, and that's concerning, for a number of reasons. But I think it is something that needs to be, as we talked about, running more sensitivities, more stress cases, that is obviously a stress case that I think that ought to be run beyond just, kind of the 90-10 kind of, longer, weather, patterns that we're seeing.
Yeah, I'll just add, I've mentioned EVgo, so we're working kind of down that path, but we also have a company that we operate called Endurant, which works, behind kind of microgrids and call it clean carbon industrial implementation, redesign of kind of older systems, which, I think will grow over time as, more local policies. We're in New York City, there's a lot of, you continue to see people blowing soot out of the top of the buildings, and I think that, 10, 15 years from now, that won't be in existence anymore. So we kind of work with them in that area, but I think to really meet the supply obligation, it goes back to, in our mind, the market construct still needs to be able to provide a return on the necessary reliability type of supply. And if the market is transparent, people will invest in that area, because the capital will flow there if there's transparency around being able to earn a return on those markets. So the market, it all comes back, what's the market's construct going to look like? And then I think if people can get comfortable with it, they'll invest in that area.
Look, I agree with Sherman about one thing, that the range around the potential outcomes in terms of electricity growth are significant, and there's a huge amount of risk. And we're solving an energy problem, and energy can be more than just electricity. It can be hydrogen, and how you produce that could change. Also, if you get scale and cost of carbon capture comes down. So how we get there, and the speed of technology and the disruption that's occurring, to bet on some significant increase in growth of electricity demand now is a very risky proposition. The good news is that a lot of what we're bringing on nowadays, batteries, others, the duration to bring them on is, much quicker, a year or so we can be more responsive to the changes in demand. But I'm not sure in the next 10 years, who's going to get to the finish line quicker. There's a tremendous amount of money going into hydrogen. That can be a part of the solution, which may dampen, the growth of electricity, because the hydrogen is not about, burning, if you will, hydrogen in a gas turbine. It affects the energy demand side of things in many different ways, and I'm just not sure that we all can envision what that's going to look like. And then there's other technologies, improvements in battery technology, all those things that can really be a game changer. And so I think it's tough for us, tough for our company to bet on a significant amount of growth in electricity demand.
Yeah, we're seeing a lot of growth in energy storage, and so one of the areas that we're working and very excited about is software to manage and optimize the value of those energy storage assets.
So, you mentioned it's tough to predict the future, and it's sort of risky to bet on a massive growth in the demand for electricity. As everybody's aware, obviously current events, inflationary trends, supply chain challenges, are weighing on the economy writ large and the electric sector. Are any of these, sort of either new or transitory, or whatever one to term it, effects sort of impacting the course you've charted for your company over the medium term or the long term, or even the near term? So,
I think the challenges that we're seeing, whether it's supply chain, availability of panels or whatever that may be, I think we're going to see some near-term delays as we work through that, but we'll continue to push that forward. We'll continue to invest in existing assets. We'll look for ways to market gas, deliver gas, market power, in a market that may see a decline in the rate of renewable penetration.
Well, there's no doubt that there's an issue, supply chain issue in our sector, and we've experienced it just like everybody else. The one thing we're not doing is signing contracts with firm dates on them, or we're making sure that we can procure, even though the cost may be higher, that we can basically get that cost into the contract. But there's no doubt that we're facing that. And that happened before, by the way, the Russia attack on Ukraine, but that didn't help matters for sure. Do I think it's going to resolve itself? Yes, because I think there's money in it, and when there's money in it, people are going to expand capacity, and ultimately we'll solve that. But I don't think it's an overnight thing. If you have scale, if you're large enough, and you have a big pipeline, and that people know that you have credibility, you have a balance sheet, you have access to capital, you can get things done in today's environment. But it isn't easy for us, and we have those things, and I know some of these guys here do too. But if you don't have that, I don't know what you do, and maybe that's why I see a lot of these fly-by-night developers putting themselves up for sale right now, because they can't, they're not going to be able to complete their projects. Just a warning out there for people. Nevertheless, the bottom line is that it's affecting all of us, and it's real, and it's definitely affecting our company.
Yeah, and the question is, we're seeing the same things with our projects. And I agree with you. I think, folks that have less access to liquidity to be able to deal with these price and constraint issues are either trying to sell themselves, or, I call it, that goes into the old development junkyard. And those are typically the projects I like to go after. But, look, for us is, if you get a sustained, we go through an inflationary period, but if the sustained cost level stays up after that period and doesn't return to kind of some normalized level, longer term question is, how expensive is this going to be? And what we've seen is a lot of state contracting and voluntary purchasers, contracting off of these assets. But where's the price break of whether they're willing to continue to go forward with that? Because at the state level, again, that's very transparent of what they're paying, and it goes back to the consumer. We saw some of that in Virginia this year with some of their programs. But on the voluntary basis, those direct company costs that people are looking at. Now, so, for me, it's still a question mark, was where do, after a few years of, call it, higher inflationary levels, where do we return to in terms of a long-term kind of, cost structure, and whether that still supports going after these technologies, or I'll say it again, does it make sense to really just try to address the issue of carbon and put a price on that and let other technologies come in to try to manage that, or whether it's technologies or computer management of how we run the electric system or whatnot, maybe cheaper alternatives.
Yeah, I think we do need to kind of sometimes step back and think about the fact that what we're trying to do in the entire sector here is, absolutely transition the grid. And that is a huge, huge undertaking. We're really cycling out a lot of the older coal assets and bringing in renewable assets and trying to keep, reliability there, first and foremost. And this isn't just happening in the U.S., it's happening globally. And so, yes, are there going to be disruptions? Are there going to be, issues? Of course there will. It's going to be messy. Absolutely, it's going to be messy, and there's going to be fraught with a lot of risk and a lot of uncertainty. It would be helpful, and I think we all on the panel agree, that if we have a more stable kind of federal, policies that help drive at least one uncertainty out of the marketplace, would certainly, I think, speed and reduce the cost of the transition. But at least as us as a company, from a development standpoint, disruptions like this are incredibly opportunistic. These are the times that if you're managing your risk correctly, yeah, of course you're going to have some failures that are going to go into development junkyard, but you're going to have some wild successes as well. And I think it's a pretty exciting time in the business. I do think that it is absolutely important to have, we all discussed, a framework to reduce, there's going to be, stuff that's outside of our control that's going to be up in the air, but a framework where we do have consistent policies that some resources are not treated differently than others, and it allows the developers and companies to go out and compete effectively for the least cost option to meet that transition. So yes, there's disruptions out there. There's going to be there's stuff that's completely outside of our control, like Russia attacking Ukraine, that will occur, and that will probably continue to occur. But I don't think that should be a moment where we freeze and go, oh my gosh, this is scary. This is a moment that we shine.
All right. Well, now we really do have 5 minutes left this time. So, I think we sort of span the gamut here of a lot of different interesting topics. And obviously, it's a challenging environment, but I mean, I think you all have managed to persevere and still, deliver new and innovative products in both this investment environment, but obviously in the physical environment. In the midst of the pandemic, I know we're able to bring some projects online and still keep its schedule. So I guess I would just say, at this stage, are there any final thoughts or anything that you'd like to address before we adjourn this panel?
National carpet price. Sorry.
From your lips. Right.
I mean, I'll say this, that, this was about innovation, and to me, you either innovate or you dissipate. And the speed, I'm just shocked by this, but COVID-19 actually accelerated the pace of business. And the pace of innovation is incredible, which creates great opportunity for us, but it also creates great risk. And managing through it is going to be incredibly difficult. The resources that we need to do it are in strong demand and short supply, including people and talented people. But we have no choice. In our seats, all of us sitting here today, and you guys out there, I mean, you have to figure out how to embrace technology and how to innovate and how to use technology in your strategy. I mean, strategy at the end of the day is quite simple. It's taking capabilities and matching those against market opportunity. But you have to have the capabilities to do it. And that comes in many shapes and sizes. But I'm an optimist. I think there's a great deal of opportunity out there. We need to work together with Gordon and Manu and others to try to put in place sustainable markets that can work. Competitive markets are the best way to do this, but it's not easy. And those guys are under a lot of pressure, but we have to come together to try to figure out how to solve this, because we are basically completely changing an economy, and as you said, Bill, not just in the United States, but across the world, or I think, Sherman, you said that. And I mean, it's just, I've never seen it like this, and it's a real challenge, but it's up to us to do it.
Well, and the companies in this room have been successful because we are innovators, but innovation is also benefited by stability. And when the rules are always changing, then we have to start focusing on our existing assets. And so those human resources that we innovate with are now focused on existing assets, trying to evaluate the potential impacts of those changes, and in some cases, mitigate the impacts of those changes. And if we're focused there, then we can't be focused on new innovative products to advance the grid.
That's probably a good place to leave it. At this point, I want to thank our panelists. I think it was a good and interesting discussion, and thank you all for observing.